Welcome, everyone. We are going to be getting started here in a few minutes. We're going to just give a few extra minutes to let everyone make sure they're dialed in. We have a sort of at capacity audience for today's webinar, so we anticipate starting in about 3 or 4 minutes. See you soon. Okay, we're ready to get started here. I'm Curtis Richens, President and CEO of Mortgage Capital Trading, and on behalf of all of us at MCT, today's webinar, which is entitled Challenges and Solutions for Correspondent Lending in Crisis. Let me start by saying that as a company, we're humbled by the interest in today's call. We have nearly 1,000 registrants for this webinar, so our apologies if anyone's having trouble dialing in. But clearly, this magnitude of attendees speaks to the unprecedented challenges we're facing as an industry with this pandemic. Now, typically for an MCT webinar, we reserve them for our clients, but given the many issues facing the industry, we thought the right thing to do was to be more inclusive and share information and insight with a broader audience. So for those of you for whom today is your first MCT webinar, welcome. Also, traditionally in our webinars, we've tried to keep a laser focus on capital markets and secondary marketing issues. And today we're doing that again, but also trying to tackle issues that transcend capital markets and secondary and affect the mortgage markets more broadly. For today, we've put together a great panel of experts from our team here at MCT, and they'll be sharing their insights. First up is Mr. Phil Rasori. Phil is MCT's Chief Operating Officer, is Chief Technology Officer, and our head trader. He's a well-known industry expert on the mortgage markets and works tirelessly on behalf of our clients to help them succeed as mortgage lenders. With that, let me turn it over to Phil Rasori.
Well, thanks, Curtis, and thank you everyone for joining. Just jump right into it here because we've got a lot of stuff to cover. Obviously, limited time. last week we did a mark-to-market webinar, which was a client-centric webinar for end-of-month, end-of-quarter issues. There was about, a good deal. There's about 500 people on that call, and so there's going to be quite a few of you that have seen a couple of these slides. But I want to use this timeline just to level set here. Just real quickly, so again, it's review for some of you, but basically just because so much has happened in the last 6 weeks, I'll just jump right in. So, Feb 19th is when we kind of see, the world kind of change. Obviously, equity's at an all-time high. Nobody's thinking there's any issues. Then from there, things start to catch steam. We did our first kind of market volatility webinar on February 28th, making some recommendations there as the market begins to really get revved up from a volatility perspective. So just, if you guys all remember, it seems like a year ago, but we're, rally all the way down to basically that morning on March 9th where, Fannie 2s, UM32s, literally we're at 103. And then everybody kind of wakes up and realizes that, there's problems are such that maybe mortgage isn't going to be the greatest thing without some serious Fed intervention. 2 days later, March 11th, we start as there's just literally a violent, retraction from those levels. We start to see the first cracks. Dealers start to report, and what we mean by cracks is in the MBS market is there's a fear as the REITs begin to get, just pummeled. There's a fear that there's going to be a glut of MBS on the market. You start to see in trades, our traders, all of you out there who do TBA trades, you start to see that when you go in for an offer, that's a dealer selling to you, right? So you're buying back, they're selling to you. The levels are good, but when you're going out and selling, that's them buying. Levels aren't so good. And so this is pre kind of Fed intervention. Things, problems were a lot different than they are now, but they were serious problems, right? The market, mortgage market was, beginning to fall apart. So the Fed kind of comes in March 15th with their first purchase statement, 200 billion mortgage backs. We, still really doesn't satisfy the markets. You're starting to see just continued deterioration. Fed adds 2 more purchase tranches on the 19th, doesn't really help. And then on the 20th, we had our webinar at that point, TBAs, Fannie 2.5s are at, 98 and a half. We had our webinar kind of talking about pull through, culling out your pipeline. Look, it was lucky from a market call perspective because then the Fed basically announces, its first of 2 cannons, basically, and so they announced basically a 50 billion a day purchase for the next week. We have a 100 tick intraday rally, and then March 23rd. The Fed really basically what our traders refer to as QE unlimited basically says we're going to purchase in the amounts needed. And so that basically changes the entire game. We just continue to rally basically through last Monday morning. And again, just credit, I didn't put a bullet point here. I should have. Credit to the MBA and a lot of industry participants reaching out to the Fed, explaining the liquidity crisis, truly an existential crisis that they were causing. That really basically flipped around last Monday. So had an intraday tank of 1.5 points because last, again, that's just 9 days ago, but we were things really weren't looking so good from a pricing perspective. Had a nice pullback on Tuesday as well, but then the last few days you kind of saw the market kind of grind up a little bit, and so But at least for now, it seems to be that at least the Fed's gotten the message there. So going back to this timeline, just kind of some of the key points that we'll talk about. Government product tightening. If we think about, it was basically 2 weeks ago exactly that actually we're close with a state senator here in this area who had texted us saying that we're out in California, and that Gavin Newsom appreciated all of the lenders responding to his Department of Business Oversight survey, saying that they would support his payment moratorium. This is, of course, before the CARES Act comes through. And, then obviously California going out with their 90-day payment moratorium, you can immediately see the next day, you can immediately see, issues that began to occur. And not that there's a complete direct correlation for California, but definitely it's not just pure coincidence that the next day you see basically a complete decimation of sub 620 government lending. We probably accelerated by us as we told our clients to remove that, remove sub 620 from the pipeline, and then the next day, that Friday, telling clients to remove sub 680. So passage of the CARE Act, then that brings us to last week on the webinar, mark-to-market strategies, and then where we are now is basically this kind of repurchase uncertainty, which we're going to talk about extensively in this webinar. So that really brings us to basically the next kind of bullet point that I should have put up, which was yesterday, Calabria's comments. This is, we're going to talk, this entire webinar is about, correspondent lending and the crises, that it's facing right now. Non-depository servicer liquidity concerns, this is where really it all started. As these payment moratoriums came in, I think all of us were probably surprised to the extent that the CARE Act extended those moratoriums. There was a lot of talk about 60 days. Gavin Newsom out here, you would think he's a fairly, a borrower-centric kind of a politician. He's going 90 days, and then the CARE Act comes out and, raises it to 180 plus an extension of 180. So, again, driven by the payment moratoriums, this is all review for most everyone. But look, I think I know the NBA, Bill Kilmer, put out a good response yesterday to Mark Calabria's comments. But look, we at MCT, we represent the small to mid-sized lender. I got a text from a longtime client of ours last night with this exact verbiage, and frankly, it is offensive. It's completely incorrect. Number one, when he talks about FHFA and the vast majority of our clients, committing cash window, when you talk about a small to mid-size servicer, I'm sure with 1,000 people on the line, there's probably someone from FHFA, and I would not, dare to say that the director doesn't understand actual, but at the same time, the small players have zero risk when it comes to, principal and interest advance on an actual remittance. So the vast majority of our clients, almost all of our small to mid-sized clients, deliver on an actual basis to Fannie. So that's again, an interesting, kind of interesting that he's talking about transferring servicing from, smaller to larger, more reputable players. So again, look, we're not going to get into, we're by nature, we're a hedge advisor. We're not going to get specifically, into the politics of that. I would say that was definitely surprising. I appreciate the NBA, and we'll continue to, do what we can to, support everyone as well. But it definitely needed to be addressed on this. So again, when we going back to our kind of crisis that we're currently in correspondent lending, all started with basically, these payment moratoriums and basically the fact that there's no liquidity facility set up for, the non-depository. I should definitely mention that Ginnie Mae's announcement yesterday that PennyMac was able to get that note structure securitization, which should provide some liquidity help for, I believe that's for HUD's previous announcement, which came on March 27th, which was that partial claim where, and we've got this link in this slide deck, but basically allows for a subordinate lien to be set up. And then basically that wouldn't have to be paid off till the first is paid off. So, just the other issues. So there was obviously already a concern in the servicing space, and then the additional Fed-driven rally really kind of cemented in the co-issuer exodus starting on March 23rd and March 24th. So what does that do? Well, what that does is if you look at MCT's pipeline, MCT generally is somewhere between, in our current client base, somewhere around 18 to 20% of the market. Obviously with hedging for aggregators, you're going to get double counting there. But let's just put this in perspective. September of last year, we're getting record volumes. We're at a $37 billion pipeline. We're at north of 60 billion by the end of March, right? So, everybody's got ridiculous volumes. So now you get the servicer issue. You get all of these buyers basically exit the market. And then now all of a sudden, we have, let's see, I guess this is 2 weeks ago now. We have, basically these lockdowns in Asia, primarily India, that begin to cripple operation centers. So multiple aggregators operation centers are now, basically crippled, and there is capacity issues. And this is against a backdrop of record volumes. So bottom line, not a lot of good news here. And so what that means is you've got record volumes, you've got limited takeouts. The takeouts that are there that have capacity issues, obviously they're holding back, additional margin. And so then we go to the third bullet point here of taking, of aggregators kind of, taking advantage may be a strong term. And I just think that, we're going to use the MCT story a little bit later. But if I could just kind of break off for a second and take everybody down memory lane here, using MCT's experience with agency pricing and versus TBA pricing, but agency pricing from aggregators, as long as you had a good investor set, there was no question there was issues, and I can take you through just quickly. The rally of starting kind of when we came onto the scene in 0203, the rally of 0203, the disruption and implosion of some aggregators of 2007, 2008, the beginning of QE in late 08. What everybody thought was an aggregator servicing crisis in when B of A pulled out in 2012, credit to Wells Fargo for really providing a bridge there till more, competition came back in. The taper tantrum of 2013, Brexit of summer of 2016. These are all huge moves. These are all big deals. But when you looked back on the pricing performance of aggregators versus TBAs, the bottom line is that a good investor set would have kept you, somewhat in range of, what your achievable execution would have been on a best efforts basis. Now we take a look at where we are now, and granted, there are a lot of issues hitting the market, but, we looked at a best X yesterday for one of our clients, and we won't name any investor names on this entire, outside of in a complimentary way, outside of this in this entire presentation here. But we looked at a best X that had a wide range of agency takeouts on the aggregator side and had, Fannie Freddie yesterday. And the best aggregator execution on the Fannie side, the cash window on the base without servicing was 100 basis points through. And so, as an industry, we're going to have, definitely a conversation about that, because we know for a fact, and again, we'll never name names, but we know for a fact that some of these aggregators in that best execution analysis deliver on an actual basis. So there's no servicing, concern there. The MSR guys will tell you, there's, you have to worry about taxes and insurance. I think anyone who knows that there's a T in mortgage knows that it's the principal and interest that we're concerned about, not the taxes and insurance from a liquidity standpoint. So that is, that's definitely something that, we're going to have to talk about. There's no question that these are not, no one's a nonprofit here, but there is definitely, some serious margins being put in. And the lenders who are delivering these loans right now are definitely, taking a hit, because of that. So the so let's go forward though, probably a bigger issue, right now is and kind of the more, more acute issue of the moment, would be the kind of agency policy directed by FHFA on purchasing a loan in forbearance, because this definitely creates, and we're going to talk about this a lot, later on in this presentation. Ben Itkin's going to talk a lot about this, the concerns that we have potentially if one of our clients were to get stuck with these loans. But there is a lot of uncertainty right now on the, again, correspondent lending side. If you are someone who is going to deliver to an aggregator, there's a lot of concern as to you are now putting your window of exposure in the hands of an aggregator as far as how long they're going to purchase the loan. And so I think it's essential, as far as coming out of this, we all really hope that FHFA will kind of, for lack of a better term, maybe come to their senses with regards to this policy. But there's no question that, he's not 100, FHFA isn't necessarily 100% in parallel with the mortgage industry as evidenced by that interview yesterday. So with that, I'd like to just kind of cut in, basically bring our director of analytics, Bill Berliner, in. And I'd like to have Bill talk about just kind of what we've seen in pricing, what we've seen by the Fed, and just kind of put it in perspective from a pricing standpoint. And then we'll speak specifically to some of the other operational issues, and then go into operational recommendations. But Bill, if I can have you take over, that would be great.
Sure. Thanks, Bill. And the thing that's always struck a lot of people based on the situation over the past month is the breakdown of a series of pricing relationships, starting with the relationship between treasuries and mortgage-backed securities, and then translating into mortgage-backed securities versus loan-level pricing, both to aggregators and to agency pricing. And what you see here is, just to give a little context to the Fed's purchases, and Phil mentioned that they rolled out the Big Bertha cannon in around March 20th. And you can see here, this is going back to the early days of the Fed purchasing mortgage-backed securities and the implementation of QE3. And they really never bought more than $22 billion in a week going back. And you see how it tapered off over the last few years. And at a certain point, the tapering program was taken to the point where the agency, the Fed, wasn't buying any more than wasn't buying mortgage-backed securities except in excess of I think it was a 20 billion cap on runoff that they had. So the purchases had gone down to where they were like 600 or 700 million a week. And this is the weekly purchases going, and they report the weekly purchases from Thursday to the following Wednesday. So you can see that by I think it was March 26th, they went from basically buying a pittance for their from their perspective to buying 157 billion in a matter of a couple of weeks. So when they stepped it up, I mean, the thing about this chart that is just how it jumps off the scale in terms of how much they've been buying. And if you put that in a little perspective, they did I mentioned they did 157 billion the week ending March 26th. And now they've scaled it back a little bit where they're buying basically 20 to 25 billion a day. But, keep in mind that gross agency MBS production in March was roughly 153 billion. So the Fed is, especially at the peak of their purchases, was basically buying monthly the gross monthly issuance of the MBS market on a weekly basis. So clearly, that's one of the things that created that huge rally that we saw from March 20th through the end of the month. Prior to that, you had days when mortgage-backed security prices were down sharply, even as treasuries were rising. Then all of a sudden, you had a 4.75 point rally over the course of like a week, say in Fannie 2.5s, the production coupon, based on the Fed basically jumping in and kind of overbuying. And my sense is that at this point, they're trying to find the sweet spot, kind of the Goldilocks point, where they're kind of putting supply and demand into equilibrium. And supply, I think, is still coming from accounts that are trying to raise liquidity. And I think highlighted by the fact that you're still seeing very large amounts of specified pools trading in the markets. So I think right now the Fed is kind of groping for that right level, and right now their calendar is about 25 billion. It says 25 billion a day, and this week thus far, they've been, on Monday and Tuesday, they bought about 20 billion, and today is a little more. Tomorrow probably scales off because of the holiday, but that's kind of what the Fed is doing, and just to put that into context. So that's then let's look at how it translates into the pricing, and here. What we have is we're showing the pricing of kind of 200,000 and greater face value of FHA 3.5% loans. So this shows just 45-day pricing from a Tier 1 aggregator versus, say, Ginnie 2.3s, the coupon that the 3.5 would slot into, and using the prior TBA close. And you can see that going back into February, they moved pretty much in line with each other. But by the end of March, you can see that the TBA price moved sharply higher at the same time that the aggregator price kind of marked time a little bit, bounced around a little bit, and then sold off pretty dramatically. And that kind of highlights what Phil had mentioned in terms of pricing. And then the next slide is going to show what happened at the to agency pricing. This is using cash window pricing for a 3.25% net rate, which net of servicing, versus Fannie 2.5. So you can see again that the relationship between the two was very stable through February, and that would look like that going back in time pretty much. Does vary, but it's a pretty stable relationship. But you can kind of see how it really became, started to violently move around by the middle of March, and you could see that how much it contracted, which reflects again, margin and being put into these the pricing towards the middle of the month, and you can kind of see how much it tightened from its previous levels in February and early March. This is not a perfect. There's a timing difference here because the pricing I'm using is based on start of day versus TBA prices from the prior day's close. It's not perfect. Stuff happens overnight, especially over the weekends. But this will give you a sense of that, how that relationship did change as the situation that we're in intensified. And I believe on that note, I'm going to give it back to Phil. Thank you.
Thank you, Bill. So, so that's basically a good overview of kind of what we've seen here. Now, we've kind of beat the dead horse enough as far as the what's happened in pricing. Now let's talk about the kind of issue du jour or issue of the week here, which basically is the kind of the purchase eligibility and repurchase issues as of kind of starting April 3rd. And for that, I'm going to bring in Ben Itkin, who runs our execution, runs a lot of sales efforts, and then also basically runs our non kind of execution for the scratch and dent side. And he speaks to a lot of buyers, already has spoken to a lot of buyers on the issues that could be frankly catastrophic with a repurchase in one of these for one of these loans. So Ben, if I can turn it over to you.
Yeah, thanks, Phil. So again, this is kind of a new angle that it's kind of come to the forefront probably over the last week or so. I guess what's pushed to the forefront is the fact that a number of the aggregators are starting to take measures to protect themselves. And so the bottom line is this, through the CARE Act and other measures that the government has pushed forth to try and protect the borrowers or consumers from several factors, but one of which is the burden of their mortgage payment. They've been encouraged to look into the possibility of forbearance on their loans. So it's very publicized, and borrowers are looking into this. And the simple fact in the correspondent space is that originators are manufacturing these loans, and there's a window of time from when they actually close the loan up to the time that the loan's sold to the aggregator, where they're essentially a bit unprotected. We're hoping for more clarity from the agencies, which is going to come obviously from FHFA, the top down. But in the meantime, all that we can go on is what's published or printed in their guides. And we've got a quote here from the Freddie Mac guide. I think it's section 4201.1, where they're basically saying that for a loan to be purchased, it has to be investment quality, which part of that definition includes the fact that the borrower could be expected to make their payments. So if in fact the borrower calls for forbearance, what does that mean? So again, this window is the period that we're trying to protect ourselves during which, and if in fact you wind up with a scenario with a loan that ultimately can't make its way to the agency, we've got some clients that go direct, we've got some that sell through the aggregators. Aggregators recognize this risk, and so they're starting to post their position on it in terms of eligibility for purchase, and some have started to take measures of repurchase, essentially saying if they've purchased it but they're unable to push it on to the agency, then they're passing that exposure back, which frankly is, I guess, kind of understandable until again we get more clarification. So the magnitude of the situation is pretty significant. Looking at it from a scratch and dent standpoint, let's say a loan that has requested forbearance or is in forbearance prior to it being passed along into the agency's possession, you run into a scenario where you've got kind of different groups of buyers in the scratch and dent space. You have scratch and dent buyers who essentially are buying loans that have some sort of manufacturing defect, but it's a performing loan. And then you got buyers of NPL, which are they take loans that are not performing. It's typically kind of separate buyers. They might have different desks, but a loan that's performing, these are a bit of a tweener now. So you got a loan that's performing, they're going to cash flow it. If a loan is in forbearance, the payments, they can't cash flow the payments, and they're not sure exactly when the payment's going to start. Frankly, some of the qualifications or allowances in these programs can be up to 12 months from what we've been reading. And then at the end of it, there's a question of whether it's going to be a lump sum or if there's going to be some sort of structure, depending on the type of loan, where it's pushed to the back of the term on the loan. But certainly there's fathomable scenarios where it's a lump sum. You've got guys that frankly, we're going into a period where folks are losing their jobs and having financial hardship. If they needed the relief of forbearance and then suddenly have to come up with 3 months or 6 months or 12 months worth of payments in a lump sum or some sort of workout plan, there's a very likely scenario where that loan runs into a performance problem. So the guys that are buying scratch and dent are scared of those loans. Then you go, okay, well, let's slot it over to the NPL side. And on the NPL side, or non-performing loans, those buyers are looking for loans that obviously they've got the ability to foreclose on. And if you're in this forbearance structure, they can't foreclose. So you end up with these nomad loans that frankly, I'm not sure if the market's figured out how to price, but the severity in terms of your situation if you're sitting on these is pretty significant. Could we flip the slide? So again, we're all hopeful that we're going to get more clarity from the from FHFA and passed down through the agencies in terms of how this is going to be mitigated. In the meantime, look, we're not trying to take a position where we're offering any kind of legal advice or compliance advice, but we do want to share some of the thoughts that have come up in conversation with our clients, and we encourage everybody to kind of cross-pollinate and speak with one another. The question has come up. The bottom line is, prior to the loans being sold to the agency, does the CARE Act even apply, or the other sponsored programs? As a lender, do you actually have to honor requests for forbearance because the loan hasn't actually been sold to the agencies yet? So that's one point. Beyond that, what actually constitutes a forbearance request? In terms of the request, if the loan is not, in order to qualify for forbearance, I think it's pretty clear that the loan has to be late in its payments. But can they request forbearance prior to that point in time? All of these questions kind of lend themselves to extending the period of time at which the loan falls into one of these categories where the agencies are basically saying we're not interested in taking the loan, or we can't, for our guidelines, take the loan. So that's another area to explore. And then, frankly, beyond that point, if somebody's holding on to the loan, if the loan goes into forbearance and then comes out of forbearance and is performing, then does it once again become agency eligible? And I'm not sure that we've gotten clarity on that one as well. So a number of unanswered questions are floating around, and guys are coming up. Our clients, we've had conversations with different strategies to try and mitigate it. Some have taken the position where They're providing disclaimers at closing that they're having the borrower sign that clearly you want to make sure that they have a job, but they're asking them to acknowledge that they have no foreseen scenario where they're anticipating going to forbearance. Some are providing documentation, frankly, at closing that says, look, we're not a government entity, and therefore we're not governed by the CARE Act, and until such time that the loan is sold to the agency, it's not eligible for forbearance. Again, we're not giving advice on what you should be doing, but just concepts that are floating around out there in terms of protection. Clearly, you want to tighten that window as much as possible. So the faster you can get the loans over to the agency for purchase, the better. And you want to be as buttoned up as you can on the front end. So at closing, making sure that they're employed and getting at a minimum a statement from the borrower that they don't foresee a scenario where they're going to require the forbearance. We've got some folks that have talked about structuring transactions where payments, first payments, will be pushed out into subsequent months. And I'm a little bit over my skis in terms of that scenario, but I guess if you close after the end of the month, then the following month's payment is through closing. So the reminder of a payment coming due is pushed further into the future, which increases the likelihood that the loan will be acquired by the agency prior to that point in time. So again, different strategies. I know we've got a number of folks on the line that are not MCT customers, but we're more than happy to chat with all of our clients, or I guess potential clients as that may be, to just kind of share ideas. And as always, we encourage our customers to share concepts with one another. So I guess with that, Phil, I'll pass it along.
Yeah. Well, thank you, Ben. And that's a great overview. I think the keys to understand there that, frankly, when I first talked to Ben Aiken about this on Sunday, I didn't quite appreciate the calamitous potential effect that that a buyback on one of these could have if from a non-performing standpoint. If the loan's in forbearance, it completely makes sense that a buyer on a non-performing loan needs to foreclose on that to cash flow the asset, but an unforeclosable loan probably represents a problem. So again, Ben knows far more than I do with regards to those types of buyers, but that makes complete intuitive sense. Look, there's a lot here that Ben went over. It's I think that's the Ben described it the best way possible, that we're definitely not obviously not attorneys, but there's a lot of there's definitely a lot of floating questions out there. And I would just say that to be clear, this is not an issue. This is not a problem. I think most of you on the line who are lenders have probably already talked to both the agencies about this. They recognize the problem. They're talking to FHFA about it. So we're definitely not blaming the agencies here. But from the agency's perspective, this is not, it's not a Fannie loan until the pool is actually certified. So that's that's definitely something, when they talk about a government-backed loan, there's definitely ambiguity there. So like Ben said, I think the first, we can definitely be a little bit of a information node there between customers. So with that, I'd like to bring in Ben Cole. And Ben has been in the industry decades, has been an underwriter in the past, has ran operations for a large retail wholesale lender, and like Ben Aiken used the term "get out over our skis." Look, we are very laser focused. We always have been on capital markets, but we have Ben Cole kind of talk about operations, because at the end of the day, in this environment, capital markets and operations are becoming very intertwined. So Ben Cole, if I can bring you in to talk a little bit about the operational best practices.
Yep. Thanks, Phil. Hi, everyone. As Phil mentioned, I'm a recovering underwriter / ops manager for 20 years. So when our traders clients have questions regarding anything operationally, and certainly a lot of this has come up over the last month, the traders always loop me in with their clients. I've probably spoken to a lot of you guys on the phone over the last month. So this slide and the next are basically a compilation of kind of best practices that I've heard over our client base. Some of this stuff you may already have implemented. Some of it may be new to you, maybe a new idea that you want to grab. But again, this is a kind of a compilation of what I feel are definitely some best practices. Again, all under mitigating the risk exposure, during this crisis. With the first bullet point, pushing the lock later into the process. I think that's been talked about for the last few weeks. Certainly on refinances, trying to push that lock to the point where the loan is cleared for docs. Reason behind that is obviously you don't have a commitment to that borrower until you actually extend them that lock. And there's a lot that could happen to a borrower from their employment situation from the time that you actually take the application to the time that you're ready for docs. So with that, you're just trying to minimize that period where you're actually committed to the borrower if something were to happen. Implementing day of funding verbal VOEs. A lot of this came out with the agency guidance regarding the VOEs the same day that they came out with the appraisal guidance. But instituting a verbal VOE the day of funding just to ensure that the borrower still does have a job, as opposed to relying on a pay stub that may be 2 or 3 weeks old. I would actually take that a step further, and you may want to push just in the current environment with the aggregators being handcuffed with their own policies, that you may want to actually push for a full VOE the day of funding. And I would use Tesla's announcement today as an example. They announced that they were going to furlough their hourly employees, but for their salary employees, they're actually going to take a pay cut. So for a furloughed employee, if you were to do the verbal VOE, it's going to be pretty obvious. HR, whoever you talk to, is going to say that they've been laid off or furloughed. But it may not be so obvious. If there's a Tesla employee that's making $100,000 and their salary was just cut to $80,000, you're going to have to re-underwrite that and re-qualify that loan. So that's why I'd push for that full VOE day of funding if possible. The next bullet point, talking about the Department of Homeland Security's website, lists the 16 critical infrastructure sectors. Really, what that's kind of helping you, try and focus, where you should put your energies when it comes to really analyzing these files. If you have a borrower who's active duty military and a co-borrower who's an ER doctor, I'm going to guess you probably don't have to worry about that borrower losing their job between the time that you fund the loan and the time that it actually gets securitized. Which also leads into the next bullet point in terms of knowing your borrower, but also most importantly, knowing the state and local stay-at-home orders. As of 2 days ago, 43 states and the District of Columbia had issued statewide stay-at-home orders, but that means 7 states have not. A good example of that is Utah. Utah did not issue a statewide stay-at-home order, but the County of Salt Lake did issue the stay-at-home orders. So within that, you're going to have to rely on your underwriters to really dive into and research what does a stay-at-home order entail, either for a city or a state. Do they define essential versus the non-essential businesses? Even though the 16 critical infrastructure sectors are certainly defined by the DHS, a city could actually define something that's not necessarily listed in there as essential for their city. Therefore, that business could stay in operation. The good news is with all this stuff, and I can say this, again, being a recovering one, underwriters are nosy rosies by nature. we're used to doing internet searches and such to try and find information either about borrowers or properties. I would definitely encourage for borrowers that are in non-essential sectors, definitely encourage the underwriters either to do website searches for the companies, Instagram, Facebook, Twitter posts. All of those are going to wind up really telling the story of what's going on with that particular business where the borrower works or possibly owns. A lot of times they're going to be communicating to their local community, hey, we're open through this, we've been deemed essential, or hey, guys, we're going to be closed, or we're going to have limited operation, limited hours during any stay-at-home order that's issued. So definitely encourage the underwriters to do those web-based searches. One of the last things would be from a loan manufacturing bottleneck, and this kind of feeds into the next slide. You definitely want to avoid any of those bottlenecks. When it comes to putting loans out for bid for sale, you definitely want to wait until those are funded. Everything is done on that loan. And maybe you smooth out or even out the number of loan sales. So you increase the frequency and decrease the size of those loan sales to avoid creating any bottlenecks in post-closing or shipping. The goal here would be to try and shorten that time frame from the day that you fund the loan to the day that you get it into the investor's hands and the day that they can purchase the loan. Some of the other things that our clients have done, and this is certainly to mirror a lot of the investors' appetites. They've increased minimum FICOs on government production, and then getting into back to the faster turn times. You really want to shrink that window from the time that you fund the loan to the time that loan actually gets purchased with the borrower. The bad news with all this is even if you do everything right, and even if you do have, the example of the active duty military and the ER doc borrower, co-borrower, there's nothing that prevents them from requesting a forbearance. I do know that there's obviously the attestation that every client or every borrower that requests it does have to sign. But the way that the CARES Act is written, there is no documentation like back in 2008 that requires a borrower to supply any documentation that they have been impacted. So that's the bad news. You could do everything right, and you could still wind up, we'll still wind up getting hurt in this if the borrower does request forbearance. The good news is definitely trust your ops staff. I'm sure all of you guys have people in operations, be it underwriters, funders, processors. I'm sure you have people on staff that went through 2007 through 2009. This will be hard for them. It's going to be a lot of extra work. The SLAs may push out a little bit when it comes to underwriting and clearing conditions and such. But trust your staff. They'll get through this. You'll get through this just like they did, 07 through 09. And with that, Phil, I'll pass it back to you.
Thank you, Ben. Like Ben said here on the second bullet point, look, obviously, this is not an aggregator problem. We don't, we don't blame the aggregators, like Ben Itkin said, for, kind of putting this, putting these policies in place. I think though, for a lender, you definitely have to take that into account right now. That from a standpoint of agency cash window, you need to minimize your potential for this exposure. Now, we talked about, there's a lot of questions, right? Of do you even have exposure, right? That's I think that's definitely a question a lot of our clients are sending. We've had clients send us, forms that, borrowers are signing. Multiple clients have sent us that. We've had, like Ben Itkin said, pushing instead of last week. And again, Ben mentioned getting out of our skis. We're not going to go into the ramifications of that, but it does make sense that if you can push into the first week of the next month, you're pushing that. If we just think of April 8th, if I'm a borrower and my first payment is June 1st, I'm probably not immediately worried about forbearance because I don't make my payment for, almost 60 days. So there's definitely a lot of strategies there, but no question for clients that currently have, this is not an aggregator problem, but because of the situation that we're in, for customers that have both, that are asking us whether or not, how to minimize that risk. There's no question that you need to if you were concerned about that risk, of the borrower requesting forbearance and potentially concerned that that would be a repurchase with the investor or a kick, which again would then be a kick down the road with the agencies, that would, your best bet is to minimize the time between when you fund that loan and when the agency actually, basically takes over, purchases that loan. And again, for the vast majority of our clients, that's going to be a cash window. And again, we're not going to get into the operations of it, but generally that can be pretty short compared to what you're doing, on the aggregator side right now. Ben left the improved pull-through forecasting communication. Obviously, we've had a lot of webinars on this over the past a few weeks with our clients. But for those of you that are not customers, obviously, communication is absolutely essential right now. And going back to some of the stuff that Ben Cole has just talked about, that's all communication driven. So, just going into a question that we're getting a lot right now from our clients is basically, we've recommended a lot of our clients that are not approved with agencies or, not Ginnie issuers, in certain cases to go back to best efforts. The problem, of course, is that if you didn't like aggregator pricing on the bid tape side, you're going to love it on best efforts. So that's currently kind of, what we're seeing right now on the spread. That what this is this is every best X we do. So on average right now in a busy week, we're going to average about 120 best execution analyses a day. And what we do is we take the best executable bid tape price and we take the best executable short-term best effort price and we compare the two. Now there's 4 investors, we're not going to name them, that we consider as kind of the top kind of investors. Not that the other ones aren't as good, but they're the 4 top investors that our clients are approved with. And again, we're not going to name them, but we will say that there's 2 depositories, 2 non-depositories. We have put the averages and spreads here of what we see for our client base. I want to make it very clear. This is very client specific. And before, some of these aggregators get annoyed with us or clients go use this is very client to client. I want to make that absolutely clear. Some clients, for whatever, pull through reasons, whatever reasons, will have bigger spreads. Some will have lower spreads. So this is on average, and this is on average going to be over 200 customers that we're talking about now. But all of these aggregators, these top 4 aggregators, we have north of 175 mutual customers with. And so I believe it's 100. So it's definitely north of 150. And so there is a good sample size there to look at. So the issue is, of course, if you're looking to move back to best efforts, and you can't do that from a standpoint of pricing to the rate sheet, pricing to the street, what do you do? And so here's the considerations that we would say, you need to look at as a lender. If you're very concerned about, you've taken a big hit, you do not have, any external takeouts, outside of, your current aggregator execution, what you need to be looking closely at is definitely, a lot of the stuff Ben Cole just talked about, but also these bullet points here. Liquidity really goes without saying. The Fed, like Bill Berliner said, we do feel that they've found their sweet spot, but I don't think you want to trust your, the solvency of your organization to the Fed finding their sweet spot. So you definitely want to be concerned. You want to, take a look at your liquidity position, margin. Look, we've preached this since our first February 28th webinar. Let me skip margin, go to lock policies. You've had there's been announcements of some of the largest lenders in the country that are holding off locking loans until the loan is, almost clear to close. So let's put these bullet point 2 and 3 together. I've talked to probably 36 customers of ours in the last couple of weeks. I am convinced there is not one happy originator in the entire United States of America. Okay, so everyone's going to complain about both of those bullet points, but the fact is that we are not in a normal time right now. We definitely need to see some clarity on these issues and some resolution on these issues before you can think about going back to normal. And again, there's going to be definitely questions about what normal is, but I know everyone is having has concerns about their originators not being happy with lock policies, with margins, but that just frankly is across the board. And it doesn't matter if you're an originator that is a lender that is approved with Fannie, Freddie, Ginnie. Your originators are still unhappy because they're not happy with the pricing that you're putting out for all the exposure that you're going to be taking from advancing these payments, especially on the government side. So there's, I think if there is a benefit we can provide this obviously to our customers all the time, but to everyone on the line here, it would be that they're, look, there's a lot of concern about these issues, but they are truly, some of these issues are existential threats. So they need to, we lock policies as far as minimizing the amount of open hedge pipeline that you have, margin pricing in as much as is humanly possible. Those are absolutely essential. Look, the lower FICO scores, I think, you guys have all seen this kind of drifted, 620 evaporated, 640 pretty much evaporated, 640 and below pretty much evaporated. Now you've got a little bit of wiggle room, I guess, between 660 and 640. You've had a couple investors go to 680. It would be my, unfortunately, this becomes a little bit of a self-fulfilling prophecy when we go out and say something like this, but I would imagine, if nothing changes here, we're headed to the 680 realm. I think, and I'm going to talk about that in a second here as far as unintended consequences, but, lending in hot zones, hopefully, you guys all watch the news. We don't really get into this very much, but we do have a tracking tool, and obviously hoping that does not become an underwriting tool. But there's no question that we have clients in some of the very hard hit areas that are extra concerned about pull through, and so that is a tool that we're looking at potentially rolling out, but hopefully with the semi good news that you guys have all seen in the news the last couple of days, hopefully that's not something that is as big of a bullet point. But just going to the low FICO, the low FICO situation, I think is really important. Like I said, we are real close with a state senator up here, and Chris Anderson used to actually work with the state senator, and so we're in contact with him. Obviously, in California, given the demographic, his voting demographic, it's tough to argue, kind of for mortgage banks, but it's very easy to argue for, limiting or denying lending to vulnerable populations, low socioeconomic populations. If you look at our database, and we just quickly looked at it, of 700,000 government loans that have been sold in the last few years through our database here, 60 some odd percent of those loans were 680 and below. So if you look and you say that 30% of the population is sub 680, it's a far higher amount, that are going to be government loans that are 680 and below. So I think that's definitely something that, depending upon how involved you are with your with your local or state or federal representative, politician, that's something that definitely should be communicated, because that is there's no question that it makes complete sense that the most vulnerable population there would be the first sector of the population to request forbearance, and as such, it makes sense that lending would dry up. And you saw that again. You go back to the California announcement; it was before the CARES Act, which frankly was worse. But if you go back to the California announcement, it literally, between Gavin Newsom's announcement and sub 620 evaporating, it was a matter of like 18 hours. So there's definitely some good kind of empirical correlation there. I think that we've been through some of these other bullet points. Definitely a huge, like I said, there was a very big scare, and definitely the Fed did not help situations from a liquidity standpoint. Luckily, we've seen that level off, and again, I would like to kind of credit and thank the NBA. I had spoken a couple times to Mike Fratantoni, who was very involved with the Fed in that. So we appreciate their efforts there. So look, I think that we're not, hopefully we didn't get you guys on this call to tell you that we're gonna solve all of these issues. There's a lot of issues. I think right now probably the first and most important issue is clarifying this from the FHFA on forbearance. I think that the interview of Mark Calabria yesterday, frankly, in preparation for this call, kind of threw us for a loop a little bit. I think it threw everybody for a loop. We weren't expecting his comments to be so perpendicular to the mortgage industry. So hopefully, and look, I think everybody, like I said, we will do our part, and I think everybody needs to do their part to make sure that this is communicated to people like Director Calabria. The issues that are the existential issues that are at play here. So that's bullet point number 2. We talked about operational capacity. We really hope that's something that really kind of created a perfect storm here. There was a lot of other issues that we talked about, but the operational issues really really kind of created the perfect storm. And we're hoping that with the Indian lockdown going up, hopefully as planned, in the next week, that would reopen those operation centers. And look, the aggregators are getting hit from all sides. Hopefully, as these the capacity increases. Hopefully there is some, at least on the government side through Ginnie Mae. Hopefully there is some, help on the servicer liquidity side. Hopefully we can kind of close that pricing disconnect. But I think that I would just tell, our story, MCT's story, in closing here before I turn it back to Curtis to close us out. MCT, if you look at us versus our peers in the industry and hedge advisory, who probably most of them are on the line right now. Historically, again, like I took you all down at the beginning of the call through the issues of kind of the historical issues going back almost 20 years, we've seen, a very strong connection between, a robust aggregator takeout set and the TBA market. There's definitely been servicing issues. There's definitely been margin issues, no question. And there definitely has been some disconnects, but nothing to the level that we've first seen. And so it changes our story a little bit on, when we look at someone doing best efforts, we now have to take a look at, you're moving best efforts to mandatory, and there's no question the large, the aggregator partners that you have already are going to continue to be, strong partners of yours into the future. But it does change the argument for us a little bit, that we now, whereas before it was always a clear roadmap that there was two steps. You take that first step from best efforts to becoming that interim investor when you lock the loan with the borrower. And then you deliver it on a mandatory basis, and then you take the next step to deliver, directly to the agencies. I think it's very clear that, just what's happened with this kind of volatility and this level of a disconnect is we definitely, that's when the dust settles coming on the other side of this. That's where MCT definitely changes, where we need to, like I said, the aggregator, the agency approvals were always, on the roadmap. Now they'll be, definitely front and center, as soon as possible, as you make this transition. So, Curtis, if you want to close us out, I think we're about done.
Absolutely. Phil, I can't thank you enough. Thanks to Bill Berliner, Ben Icken, Ben Cole for sharing all those important insights on these important issues. So a great job for all of those that are still on this call. And we went a little over time, but we hope this information was helpful and hopefully actionable. I think Phil alluded to, and encourage people to advocate, on behalf of the industry for these issues that affect so many of us directly. From MCT's perspective, we're here to answer questions and look forward to having further conversations on these topics with clients and others. And finally, look, we'll be distributing this webinar recording in the next day or two, so you can look for that in case you missed any points. But until then, take care, be safe, and thank you for your time today. Thank you.
Thanks, guys.